All right, welcome. My name is David Kennard. I'm the 2025 president-elect. I'm pinch hitting for our president, Kyle Hembry, who is on a well-deserved vacation. Thank you all for coming this morning to the insurance update and outlook. I'm saying this with a straight face and all sincerity. I'm excited to hear about insurance. This topic has been a pain point for investors, for owners, for tenants alike for a while. And the more we know about the topic, the better advisors we can be to our clients. Before I get into introducing the panel, I'd like to thank our sponsors. We have some bronze sponsors: South State Bank, Finch Roof Consulting, SVN, and Synovus Bank. Silver is Ian Black, Atlas Insurance, Cruise Bank and Trust, First Horizon NDC, Sabella Marshall CPA, and Michael Saunders Commercial. And of course, our gold sponsors: Hembry and Company, SWF Home Inspections, Berlin Patent, and Stellar MLS. The sponsors make these events happen and throughout the year, and we're really grateful to have them as part of the organization. There are two other groups in our organization that make CREA happen. One of them is the dedicated staff at RAISM, especially Max Brandow. Thank you, Max, for everything you do for us throughout the year. And the last are the volunteers, the folks who give their time to committees and on the board that make events like this possible. Now, this is the time of year when we put out a call for people to serve on the board and in the committees. So if you'd like to be part of CREA leadership in 2026, please feel free to reach out to me or to Kyle or to Max and just let us know. We'd love to have you on the team. Finally, one reminder, we have these panels and these presentations once a month. We have registration for them. It really helps the staff know if we can get a head count ahead of time. So please remember to go out to the RAISM calendar and check in and register ahead of time. So with that, I'd like to invite William here to introduce the panel and moderate the discussion.
Right. Thank you, David. For those of you who don't know me, my name is William Wilson. I'm on your 2025 CREA board. And on behalf of RAISM staff and our board, I would like to welcome our panel today. So how the program is going to work is each one of our panelists is going to have about a 20-minute or so PowerPoint presentation. We're going to target to wrap up sometime between 12:40, 12:45, where we'll have Q&A after that. We'll try to wrap up about 1 o'clock, and we don't want to keep them here forever, but they'll be available for a couple of minutes afterwards. And all of our panelists have actually been here before. So I introduced Christine Ashburn from, is it Delegal and Aubuchon? Delegal and Aubuchon. She's the Senior Policy and Business Strategy Advisor there. She is a lobbyist and has extensive background in insurance and legislative advocacy. And she brings over 20 years in government and consulting and advocacy. Christine, prior to her position, and when she was with us last year, she served as Chief of Communications, Legislative and External Affairs for Citizens. In that role at Citizens, she provided executive leadership, legislative programs, communication, media, crisis communications. We don't ever have insurance crises in Florida, so that was probably pretty easy to do. Employee communication, social media. And during her role at Citizens, she played a key role in passing significant property insurance reforms. A lot of big ones that happened included those that are related to sinkholes, assignment of benefits, repeal of one-way attorney's fees, and developed overall communication and media strategy. So thank you very much, Christine. Thanks for coming back. We appreciate it. We didn't scare you off. Do a good job today. You never know. We might call you again next year for the 2026 insurance update. And then at the end, we have Stephen Mostella. Stephen is a returning panelist for us. He's Vice President of Underwriting at Citizens. So you have all the answers, Stephen. He's responsible for providing strategic oversight for the company's personal and commercial lines and in delivering business results that are aligned with the organization's mission. He joined Citizens in 2001 as Director of Commercial Lines. I'm always fascinated by that. I'm a commercial lender, so exciting stuff. And he led and initiated various operational changes to improve management of the company's commercial book. He's an accomplished property and casualty insurance professional and leader with 30 years in the industry. And then prior to working at Citizens, he worked with State Farm, 12 years in Florida, He is a chartered property and casualty underwriter, which is a serious insurance designation. And he served as the president of the North Florida CPCU Society for many years. And then lastly, we have Mark Sobolewski. Mark's a CREA member. They're our sponsors. Thank you so much. Mark joined Atlas Insurance in 2018 after graduating from the University of Florida with a Bachelor's of Science in Sports Management. Prior to finishing his undergrad degree at University of Florida, he played baseball collegiately at the University of Miami and then professionally at the Toronto Blue Jays and the Minnesota Twins. So we got our very own celebrity here. Celebrity Insurance Dynamo. And then Mark is a Sarasota native. He grew up in Sarasota. He met his wife, Danielle, who's a kindergarten teacher here in the community. He enjoys mentoring young athletes as a coach at Sarasota High. And he's recently been promoted, I think now, to head baseball coach at Riverview High School. So excellent job. So how we're going to do this is we're going to have Christine's PowerPoint presentation first. Then we're going to have Stephen's. And then we're going to wrap up with Mark's. And again, we can try to hold our questions to the end. That's fantastic. If something is just burning your brain, give us away, but we'll have plenty of time for questions. So with that, Christine.
Thank you. Thanks for having me back. And I appreciate when I get invited to come here. I, like Mark, am also a native. I was born and raised in Bradenton. So my children thank you because they're hanging out with grandma right now on the water. So, well, kind of, sort of, the pool works, but they have no docks. No boat, thank you to Milton for all of that. They're on the bay in Bradenton. So appreciate you having me. I'm going to kind of give a global perspective of, can you all hear me? I can't tell if this is, okay. Is it on? Okay, great. Of kind of what we saw this session and kind of what I think, what we all need to be aware of for the coming years ahead. We're in defense mode, but that doesn't mean we don't have work to do still. So 2025 session update for all of you who may not be aware, the 2025 legislative session that was scheduled to end on May 2nd ended last night, late. They finally got the budget completed. I guess it's a good problem to have when you are haggling amongst the leadership about how to deliver tax reductions. I think that's obviously better than having a session extended because you have no money and you're trying to cut programs. So that just ended last night. So you'll see lots of press around tax, what's coming our way, and tax relief, what did and didn't get funded all over the media in the coming days. So just what did pass. It wasn't a big session. I'm going to spend more time really on what didn't pass, but I did want to share what did pass. So House Bill 913 relating to condominium associations did pass. This is what they called the Condo Bill 3.0. As you all know, following the Surfside collapse, there have been a huge number of laws changed to try to ensure that we never see that happen again. And I know you all know the pain points around all of those necessary but hard to take changes with regard to reserving and those things that were candidly, the can was kicked down the road for, almost 20 years on a lot of those reforms that needed to occur regarding reserving and those kinds of things that might have been able to change the outcome of what happened at Surfside. So we certainly don't want to see that happen again. The bill in the insurance space, there's a whole bunch of stuff in that bill, but I did want to kind of hit some highlights for you on the big items. The bill clarifies that every condo association must provide adequate property insurance as determined under 718-111, regardless of any requirement in the declaration of condominium for different coverage for the association. So apparently there have been some conflicts there. This clarifies that the statute rules out. It doesn't matter what you put in any other governing documents. You got to do what this statute says as it relates to property insurance coverage. I don't know if that was what I would call a solution in search of a problem, meaning this wasn't a problem, but they wanted to be really, really clear, or if there was evidence of some associations not following what was intended in the law because they had governing documents that were different. Mark may know more, may have seen that. There's always a story out there that drives what happens in Tallahassee. The bill also provides that the amount of adequate insurance coverage for full insurable value replacement cost or similar coverage may be based on the replacement cost of the property to be insured as determined by an independent insurance appraisal or update of a previous appraisal. The bill requires the replacement cost be determined at least every 3 years. That is slightly different than what was in the law prior. And the bill also provides that an association's obligation to provide adequate property insurance coverage for a group of at least 3 communities created and operating under Chapter 718 through 721, differing apartments, different types of associations or condo and or commercial res structures under different laws may be satisfied by obtaining and maintaining insurance coverage sufficient to cover an amount equal to a 1 in 250-year probable maximum loss instead of a full replacement cost. So I'm going to spend a minute on this third bullet. And of course, if you have questions about this, when we have questions at the end, please feel free to ask them. And if I don't have answers, I will certainly get back to the group and they can send them out for you. This one I'm going to spend some time on because I am hearing that this item is being advertised by some groups as a new potential avenue for coverage that's going to be cheaper. So what this allows is replacement cost is you have to have coverage all the way, what it would take to rebuild the building if it was destroyed, God forbid, like a Surfside. Now, the likelihood of that happening because of a hurricane for these massive structures is not huge. It's a very low likelihood percent-wise statistically. The likelihood that a hurricane could take out all the way, fully destroyed, a tower on the beach. I mean, it would take an event that we would all be waiting for the feds to come down, I think, if it's built to the right codes, et cetera. Right? You're just not going to see these things collapse like we saw, unfortunately, in that scenario from a storm. But there has been some on the condo association, or grouping side, advertisement and post-session updates that have gone out talking about this potentially being a new avenue that could be cheaper in the space, that carriers will be offering it. I don't know at this time. I represent one condo, the largest, in fact, condo association insurance company, American Coastal Insurance Company, behind Citizens in Florida in the admitted market, so not talking surplus lines, that writes condo associations. So I was obviously engaged in this discussion. This statute has actually been on the books for a number of years, but it was written in such a way that it didn't say that it was allowable because replacement cost has always been there. So the way the statute was structured, it sat there, but it was in direct conflict with replacement cost, right? So it really wasn't sold for your main structures. I think it has been available for some ancillary structures. It's out there potentially as an option, but not for the full association policy. I don't know that there is going to be, this was something that was clarified by the condo association world, not the insurance world driving it. I don't know that right away there's going to be a flood of insurers or any that are interested in picking this up as a product today. I could be wrong on that. But I will tell you also, one of the things that I am hearing from our friends at the Florida Association of Insurance Agents who couldn't be here today because their convention is starting, they're hearing from some of their brokers and their agent members that there's a lot of talk in certain areas where condo association boards have heard about this and are excited that they're hearing it might be cheaper and it might be an alternative and a cost savings. Could be. I don't personally believe that it will. And Stephen, maybe you and Mark could speak to this. A 1 in 250-year return period for a storm is a really high standard. For example, in order to be insured, that's for a reinsurance purpose. You have to have coverage to cover this amount, whether it's through your own surplus, reinsurance, catastrophe bonds. You got to have funding to cover that big of an event. For context, Andrew was a 1 in 49, 46-year event, right? So just for context of what kind of storm, none of our storms that we've seen are anywhere near a 1 in 100. So when you think about insurance companies in Florida, licensed, regulated, have to have reinsurance. They are not required by the Office of Insurance Regulation to reinsure to this level. So if you were to take 3 associations, 3 communities together to build this product and have to have cash or reinsurance or financing available that's appropriate under the law to cover a return time that is this high, meaning any or all of your structures could have this much damage in a season, in a year, the likelihood of that happening is such a small amount of risk that the cost for the reinsurance and the cost to finance to that level, at that highest level, really isn't where the money and the cost is built. Most of it is much lower than that when you talk about a tower of coverage and reinsurance at a return time. 1 in 250 is really high up there. I don't know that if you even were to see that product available, it would be that much cheaper because the likelihood of loss at that level is so low. That being said, it is a product that would absolutely be clearly available if offered in this market. I just don't know that some of the marketing that's been around it and touting of success as an option around this by the condo association representatives from Tallahassee really actuarially will play out. Now, I'm not an actuary, play one on TV, stayed at Holiday Express, worked at Citizens for 19 years. So I've spent a lot of time in that space helping educate around that. I just don't know that I see that as a cheaper product. So just to give some perspective, if you hear that out there from some of the, if you're doing closings and working, if you hear that from some of the insurance folks, I don't know that this is going to be, and Mark probably can, if you want to touch on that.
Yeah, it's an interesting topic. I would compare it to something called parametric insurance. Who's heard of parametric insurance? You probably, if you haven't heard of it, you probably don't have a coverage that's written on that kind of format. But we'll get on the agency side. So we'll have brokers, we'll have representatives from different carriers, either admitted or non-admitted. They'll come into our office all the time throughout the course of a year, and they'll be talking about their capacity and their appetite and what types of properties they want to write versus the year prior or maybe the years prior. And so they'll talk a big game and they'll talk about maybe changes in rate and different things. And sometimes they follow through. Usually they have one or two niche products to really pitch. And I'll go back to parametric insurance. So parametric insurance doesn't actually take a loss for the insured to recover money from. Basically, so if you have parametric insurance and the stipulations are, if there's 100-mile-an-hour wind in a given zip code, whether your property is fully intact or if it is, like it never existed, you collect on that policy. So it's almost like you're going out to Vegas and you're kind of gambling and you're saying, do I think we're going to incur a storm or an event that checks these boxes? If so, whether I have damage or not, I can collect on this parametric insurance policy. And it's unique for certain types of risks. Maybe if you have a large property schedule and it's spread out throughout the state, it may make sense. There's different reasons why it could be attractive. What I've not run into yet, I've never sold one, and I don't know anybody at Atlas, Haley, and I don't know if the interns would know here. I'll introduce you in a second, but I don't know anybody really writing these, because when you go start to break down the rate and what the premium entails and the benefit, it's not really a good bet. And so anytime you talk about a new product or a new way of insuring something, it's attractive. It's more so interesting than it is attractive. And as this kind of develops over the course of time, maybe this becomes the way to do it. But from a underwriting perspective or an actuarial perspective, I don't really know how it would play out. And again, we haven't gotten a ton of people coming in talking about this yet. When we do, I'll be happy to relay it.
Right. So thank you. Right. And I think parametrics are great. I know Citizens, I think Stephen even took a look at it. Maybe we looked at it maybe last year, even for Citizens. And so this will be, I think you're right. It'll be in similar space. It sounds good. It's interesting. It may be a part of the pie of solutions. I just don't expect it to be a tomorrow thing. Right. So just wanted you to be aware of that, because there's been some talk around that. And I know I've heard from FAI that they're getting some calls saying, I think there's worried about gamesmanship in it, but I don't know of anyone that's jumping into this space. I said, Stephen, I don't want to speak for Citizens, but I can't imagine you guys you're going to take a lead on a new product either.
No, something like this.
Yeah. So, because then he'd be the only one that has it, and then people would come to them, and that's not what they
It's our
want.
purpose. Yeah.
That's right. So, right. So these are the highlights of what passed. I'm happy to share if you want to, let me go to my next slide. Want to dig into more of all of the very specific condo pieces there. They have given some more time for certain structures to get their SIRS done and things like that. So they have allotted for some of those exceptions in this bill as well. But I did want to focus, since we're talking insurance today, on the insurance piece. I also wanted to point out on that third bullet regarding that 1 in 250, there are questions out there about whether it would be compliant with the requirements for Fannie and Freddie. and trying to get a straight answer out of Fannie and Freddie. Best of luck with that. Stephen and I worked together on a couple of issues several years ago, and I still don't know that we ever got answers from them on what we were trying to get answers on. And the hurricane season came and went, and luckily, whatever we were asking about didn't come to fruition, but I think you're probably still pending an answer from them. So usually their answer is sure, but you'd have to get Congress to change the law. So just an FYI, that is something that kind of looms out there. And in fact, Senator Bradley, who was the Senate sponsor of that bill, did not have that provision in her bill to start. Representative Lopez did. And I was speaking to Senator Bradley on a couple of other insurance issues. And she said, hey, while I've got you on the phone with your background from Citizens, what are your thoughts on this? And I said, I don't think it hurts to clarify the law. It's always been there. It hasn't been used. I don't know that anyone wants to use it, but better to make it so it's really written correctly if there isn't a desire. And she said, what about Fannie and Freddie? And I said, I would think that if they wanted to, it's not full replacement costs. They probably could raise a flag about it. And they are not very malleable and, lovely folks that work there forward thinking about changing things, and new products are not really their thing. So I don't know. I think that there are questions about whether Fannie and Freddie could raise issues on that type of product if it was in their wheelhouse. So when I said I wanted to focus on what passed, I also wanted to spend kind of a little bit more time on what didn't pass. So as you all know, at the end of 2022 and in the 2023 regular session, we had landmark reforms that really set this market on a path with an ability to be successful. For 100 years, there was on the books in Florida a statute that we lovingly call the one-way attorney fee statute. 627-428 was the citation that in December of 2022 was amended in a special session to say that you could not use this one-way fee statute for property claims anymore, for property litigation. Let me tell you what that statute did very quickly, for those of you who don't know. If you have a dispute and you end up in litigation, if a company is offering as a settlement for ease of numbers, $25,000 for the damage, say it's a roof, and we say, we all agree there's coverage, or maybe not, but say we do, but we are disagreeing on how much damage is going to cost to repair. The carrier says it's $25,000 for, again, ease of numbers, and the association says it's $125,000. You go to jury, you go to a trial, and the jury says, well, company put on some pretty good, arguments, and I don't think it costs $125,000 to repair what they're saying, but maybe 25 is a little low. So let's give them, we're going to say it's $35,000. They wanted $125,000, but the plaintiffs awarded $35,000. Really, the carrier did a much better job of defending the case, right? They were more right than they were wrong on the numbers. What juries didn't know was that in awarding $35,000 instead of the 25, even though the plaintiff may think they quote unquote lost, they didn't get the money they asked for, the attorneys have won, because the insurance company then owed all of the plaintiff's fees. So the actual insured got a $35,000 verdict. The plaintiff's attorneys could have hundreds of thousands of dollars in attorney's fees that had to be covered by the company. Juries weren't allowed to know that. So that's what the one-way fee statute did. If a company paid $1 more in settlement than what they offered, they owed all the attorney's fees on the plaintiff's side. All of that money goes into rates. It was a statute that was well-intended, David versus Goliath. You're the consumer, you can't afford the bevy of attorneys, but it was bastardized by a small pocket of bad trial attorneys who were filing frivolous lawsuits by the hundreds and thousands, knowing that companies didn't want the crapshoot of a jury trial. So they would settle cases that they believed they were right, and they would always have to build in, as part of that settlement, fees for the attorneys. And it may not be $100,000 in fees, but if you do 7,000 cases a year and you're getting 10 to 15,000 in fees every time you settle, it's a windfall. Plaintiffs' attorneys didn't want to ever actually try cases. They wanted to settle at the courthouse steps and make companies pay a little more for the consumer and a boondoggle over time with the volume of cases. We see it in auto, we saw it in property, we see it in all kinds of lines of insurance. So it was eliminated for property in December of 22, and ultimately the entire statute was repealed in House Bill 837 in the regular session of 2023. Can you still get fees in certain instances under the statute? Absolutely. If there's bad acting, if it's egregious, but right now everyone pays for their own fees. That really is. There are certain circumstances though where absolutely a company could be on the hook for the plaintiff's fees under current law without this one-sided fee statute. So this coming session was the first session following all these reforms where we didn't have the same leaders in the House and Senate who passed those reforms. We have a new speaker and a new Senate president, but we still have Governor DeSantis. So he spearheaded those reforms with Senator Kathleen Passidomo, who is president from the Naples area, and Speaker Paul Renner, who was out of the Jacksonville area. So now you have Senator Ben Albritton, who is from Wauchula, center of the state, a little bit north and east of here, and Speaker Danny Perez, who is out of Miami. You still have Governor DeSantis. Katie barred the door on the number of bills that were filed to undo, and in some instances, make worse than the old law for fees to try to get access to fees. They showed their hand at the legislature. This is all about fees. This is not about consumers. They will argue access to courts. I can tell you, insurance companies, I'm sure that Stephen can tell you, Citizens is still getting sued, okay? A lot, I think. But it gives the carrier a more level playing field to not feel like they're being held hostage to have to settle and pay fees to get out of litigation because they're afraid to go to court. So the reform, what these bills tell me is the reforms are working. We've seen, I don't want to steal Stephen's thunder, I think you've got this in your presentation, OYR, we've seen, I think, 12 new carriers come into the market. I will tell you that my client, American Coastal, is growing. They had an earnings call and had a shareholder call, and they've seen a lot of positive news. Reinsurers were thrilled by, that's the insurance that insurance companies buy, were thrilled with the reforms coming back to Florida. Florida used to be the wild, wild west, all these good things. Well, ticking away at this is what they're trying to do. And they did it in MedMal. They came at all, you wouldn't believe the bill. I mean, just the first week of session, the number of bad attorney fee related bills that dropped, trial bar bills, was higher than it's been in probably a decade, all at once, right? They're coming for it. New leadership, new opportunities. A lot of the really bad stuff passed the House of Representatives, but wasn't ever heard in the Senate. So they've got juice in the House right now. So there was legislation filed to expand Citizens to write wind-only statewide. And then one bill sought to limit or prohibit the use of AI or similar technology in claims denials. Of course, you don't want a machine just denying claims, but we don't know what's coming in technology, so we don't want to write statutes that limit carriers' ability to find cost-saving ways to handle claims probably more quickly, so that after a storm especially, we can get people made whole again. So, what's the impact here? Okay, so who cares? They filed a bunch of bad stuff. What does that matter? Well, it does. Even when bad legislation fails to pass, it absolutely can have a negative impact on the Florida market. Signals are sent to potential investors and reinsurers that the political and by way, the regulatory landscape in Florida is unpredictable. We have been known for that for my whole time. I've been lobbying in this market for 21 years. I've been in the lobbying world for 26 years. The unpredictability of what the legislature does in Florida is harder to predict than hurricanes sometimes, right? Investors don't like that. Reinsurers don't like that. They look at this as uncertainty, as an increase in potential risk, which can lead them to increasing the cost of coverage for reinsurance, which goes straight into rates. And in potential investors, already a risky state to be in. We got more coastline than anywhere else. We live in a beautiful place, but we are susceptible to hurricanes. This area, I think, we've had all these old wives' tales about, Sarah DeSoto and keeping this area my whole life safe. Well, that fell apart this past year. Obviously, Helene did some significant damage, and we took a direct hit here for the first time. I'm almost 47 years old. In my lifetime, we had a direct hit. I mean, Hurricane Elena scared us a bit in the 80s, but she moved along. So that on top of that risk, the risk of the uncertainty, what happens regulatory and leader, politically here, makes them start to question. I cannot tell you the noise we heard from our company clients, and I think, Stephen, you can speak to it, Mark, you can, When session started, it was like, what is Florida doing now? Here we go again. So it's important that we keep up the good fight, because I think we're going to continue to see this in the 2026 session. We don't know who the governor will be after Ron DeSantis. Governor DeSantis is a steadfast leader on this. We don't know we don't know who the next governor will be. We will have Senator Jim Boyd, who represents the Bradenton area, the district just north of here. He will be the Senate president for the next 2 years following the 26th session. He is an insurance agent by trade. He's a champion of understanding and seeing in his own business, in his own backyard, what has happened to this market. And he was a significant reason that these reforms were passed. So he will do what he can to stop the undoing of what's happening. And I think the further we get away, we've had no insolvencies, guys, since these laws passed. Look at the storms we got hit with. All the carriers are making it. That's a good thing. We had 11 insolvencies prior to the reforms in recent years. We've had 0 since these reforms changed. The reforms are working. Should we expect to see more legislative changes? Attempts to? Absolutely. What will happen with rates and premiums and the availability of coverage? I think we're going to continue to see more folks come to market. Will these storms slow down growth a little bit? Sure. But we're still seeing carriers write more. Citizens, Stephen's going to show you some great news on the size of Citizens, which is 100% because of the reforms. Even with storms, by the way, folks want to write new business. We haven't seen this in years. 26th election, like I said, we don't know who the governor's going to be. So it's not time to let our guard down. It's not time to stop talking about the importance of having a healthy market. And what you're going to see, you're already seeing it, are negative headlines. The trial lawyers are going to, and already are, on a full court press to paint the industry as a bunch of greedy, awful people who don't pay claims. Look, insurance companies, like anybody else, you got good ones, you got bad ones, you got good actors, you got bad. Mistakes can happen. No one's perfect. But we've got a phenomenal commissioner with a lot of strength in his statutes to go after the bad guys. He is actively doesn't want bad carriers in this market. There is a good system set up. There was insurance accountability bills passed at the same time as these reforms to give him more teeth to go after bad actors. We got to let this market rest. We've got to give this more time. We're already seeing good news. I believe more good news is coming. I'll tell you that American Coastal in January started a new product line for apartments. They're growing their business. We're starting to see commercial carriers come back to this market after Surfside. There's a lot of good news out there, but you're going to see in the media absolutely bad articles at every turn that they can get written because they want to paint the picture that all insurance guys are bad and they're the saviors and the reforms are all one-sided. I do not believe that is the case. If I did, I wouldn't sit here. I wouldn't have worked on them. I'm an insurance consumer in Florida, just like you guys are. So with that, I will hand it over to Stephen and we'll answer questions at the end. So thank you for your time.
Thanks.
Okay, thank you.
Thanks, Christine. Okay, great. So Christine did a wonderful job, especially the last 10, 15 minutes where she talked about the legislation that did not pass. That is so critical because a storm, legislative sessions, any of that can change the positive motion that we've seen with the industry so far. So what I'm going to talk more about is the here and now as it relates to the industry, talk a little bit about Citizens, and talk about commercial at Citizens. So here are some headlines that we started to see late last year in the first half of 2025. Florida property insurance market sees first underwriting profit in 8 years. New insurance companies launches in Florida signaling market improvement. Florida insurance market is stabilizing. Florida OIR approves transferring more Citizens policies to private insurers, which we call depopulation, and I'll talk more about that in a minute. Property insurance reforms are working, which is something that Christine emphasized a few moments ago. And the study, Florida property insurance market, most stable in decades. All of these are positive headlines from the local news, newspapers, insurance industry reports. The Florida market here and now is certainly moving in the right direction. Here's some information that was provided by the OIR to give a little bit more meat to what does it mean that the market is improving? What does that actually look like? When you look at the average monthly request for homeowners rates is 1.2% compared to 14%. Big difference. There we go. 13 new homeowner insurance companies, Christine mentioned a minute ago. That is phenomenal. To me, that is probably the most key factor, that we have more insurance companies coming into the state, which is good for the consumers, giving them more options, hopefully in time, stable, if not reduced premiums. So this is key. Among the state's top 10 insurance carriers, 60% have expanded their business, 40% have filed for rate decreases. And since January of 2024, 17 companies have filed for rate decreases and 34 have requested no change or increase. Reinsurance costs significantly decreased from 2022 to 2025. Again, I hate to keep repeating this, but what Christine said about reinsurers watching, listening to the insurance market, when the reforms passed in 2022, 2023, that was a positive. We started to see the reinsurance rates stabilize and go down. And I did hear, as we were going through the 2025 session, the reinsurers started to get a little nervous. They started to hear chatter about what was being discussed. Is Florida really thinking about changing the reforms they passed just a couple of years ago? I'm glad that this was a light P&C legislative issue or session. Hopefully that will continue in the future, but it's a concern. Insurance carrier ratings in the state generally improved, and this is the AM Best, from that standpoint. And then Citizens Property Insurance reporting decrease in policies, with over 600,000 policies removed through depopulation in 2024 and the first half of 2025. So this is from the OIR. The Florida Chamber of Commerce emphasized a lot of these points, and it all points in the direction of, yes, the market is improving the here and the now. The next slide really looks at some of the financials. I mean, because any entity, any business, you have to make a profit, and it's critical for the insurance companies that are in the state that they are profitable. One of the headlines I mentioned a few minutes ago talked about this is the first time in 8 years that the market or the insurance companies have seen a profit, and this is what this graph is showing. So you can see on the right-hand side, there are many years where it's below the numbers, or the bar graphs are below. That represents a net income loss or a net underwriting loss. When you move to the far right-hand side for 2024, now you're beginning to see those numbers on top, which represents net income gain and net underwriting gain for the Florida insurance companies. That's a key element, that's a key sign, that's a very positive sign. This is also another indicator of evidence of the market improving. So these are 3 pie charts representing 2004, 2011, and 2024. And this represents the market shares. And the pie charts are broken down into 4 sections. One, of course, is the blue, which is Citizens. The yellow is what we call PUP companies. These are subsidiaries, basically, of major insurance companies, like a State Farm. State Farm doesn't write in Florida, but State Farm Florida Insurance Company, which is their subsidiary or PUP, does write in Florida. So we have several PUPs. You can see the percentage of the market they make up. The green is the other, which are the national carriers. And then the orange represents those that are based in Florida. You may have heard of Slide. A new company that's came on board is Patriot Insurance. So those are some of the Florida insurance companies. As you move from left to right, you can see when we look at the Citizens piece of the pie, it was 15% or so in 2004. We grew to over 23, about a quarter of the market in 2011. And now when you move to the far right-hand pie chart, you can see we're only about 10%. And this is based on the end of 2024. Last week, I was able to get an update on this, and now we're down at 9% of the market, Citizens. That is great. That is great. We have a unique business model at Citizens. Not many companies celebrate losing revenue or losing market share, but being who we are in the state of Florida, we do celebrate that with our employees, because this is success. This is good for the insurance consumers in the state. So when we look at the citizens policy count, this is what this chart represents from 2004 up until 2025. You can see we go through a cycle. We had a down cycle where we were very small, market was in good shape for about 5-6 years. And then starting in 2016, 2017, we started to see the uptick. We capped out at about 1.42 million policies in September of 2023. That is a very significant, that's over $500 billion of exposure that Citizens had in this book of business. Citizens cannot sustain being that big. That's a bad sign for the condition of the market. But when you look at the past 2 years, year and a half, 2 years, you can see Citizens slowly, gradually declining in this policy count. And this is a combination of personal lines as well as commercial lines. So where we are today, we're about 800,000 policies, which is a good size for Citizens. We're guesstimating that we may lose another 100,000 policies this year, which will get us down to about 700,000. You know, a conversation I have with my employees a lot is, well, will Citizens ever go out of business? Will there never be not be a need for Citizens in the state of Florida? And the answer is there always will be a need for Citizens in the state of Florida. We feel that 650, 700,000 policy count is probably where we will level off. As long as we are peninsula, we're surrounded by water. We have 400,000 people, I think, moving to the state each year. There will always be a need for a Citizens property insurance company. But we want to be small, which represents a strong P&C insurance market in the state. And this is just a heat map representing the policy count where we have the concentration of our policies. The dark orange, dark red represents where we have the highest concentration of policies. South Florida, Southeast Florida, by no surprise for anyone, that's where we have over 1/3 of our policies. But I also highlighted Manatee County and Sarasota County on the West Coast. I think combined, if my math is correct, about 39,000 policies with Citizens in those 2 counties. I know there may be other smaller counties around, but I just wanted to focus on those 2 counties so you get an idea of how Citizens is working in this particular part of the state. Depopulation. Is everyone familiar with the term depopulation and what it means? Okay, so, and if you're not, that's fine. So depopulation is basically a program at Citizens. Again, we want to be smaller. So the depopulation program is an effort for us to help reduce the size of our book of business by giving other companies a chance to take policies away from us. You probably have seen depopulation a lot in the news, and it's a very successful program for us, especially in 2024. In 2024, we depopulated around 477,000 policies. In 2025, we've already depopulated about 155,000 policies, which is about half of what we projected for this year. So if we do actually depop another 150,000 so policies between last year and this year, that's well over 600,000 policies that have gone to other carriers writing in the state. And what that may mean for the policyholders, especially, primarily homeowners, is they could, in some cases, get better rates, but in most cases, they are probably getting a better product with more coverage options available than what we do offer as Citizens. So the activity of the depopulation is good for Citizens, but more importantly, it's good for the state. It's showing that carriers are interested in growing their business in the state, and they want to take policies away from Citizens. And when we talk about depop, it also applies to commercial lines. Of course, the big numbers are all driven by the homeowner side, but there is a commercial lines depopulation. 2024, we did depop about 2,000 commercial policies, mostly condos. And so far this year, we've depopped about 290, 300 commercial policies. And speaking of commercial policies, this next slide really just shows a historical picture of how Citizens has grown, how we have a decrease, and now we've started to decrease a little bit more in our commercial policies. back 10, 12 years ago, Citizens had a tremendous size of commercial book of business, a lot of condos. I think, if I remember correctly, we had like 50% of the condominiums insured in the state. But over the past decade or so, you can see where that number has decreased significantly. We made it down to as low as 4,000 commercial policies. In 2023, there was an anomaly that hit the market, and Citizens doubled its size in commercial policies to 13,000. A lot of those policies were condominium towers. And surprisingly, some of those condominiums we wrote were built just in the past 3 or 4 or 5 years. But what we heard from the agents at that time was the rates were just so high, the renewal rates were so high that Citizens was their only option. And that's extraordinarily concerning, considering the type of policy that we offer at Citizens for condos. It's as vanilla and as basic as you can find anywhere. It's called Basic Pearls, and I won't go into all the details. But in order for a condominium, especially one that new, coming to Citizens because they have no other option, spoke loudly about what was happening in the condo market at that time. But since then, we have seen a decrease in our commercial policy count, and especially a decrease in the number of condominiums that we write in the state. In this last slide, I just want to briefly talk about, it's more personal lines, but it's something that I think would be good for you to be aware of, is back in 2023, there was a legislation passed that requires all Citizen policyholders to have proof of flood insurance. So any policyholder that is with Citizens in time, they must provide proof of flood insurance, that they have flood insurance. As you can tell on the slide, it was a gradual event that we will start requiring it based on the value, the replacement cost value, not the market value, but the insurance value of the home and the flood zone location of that property. So we went through the first couple of categories in terms of special flood hazard areas. So all of those policies now, if they're with Citizens, they have proof of flood. Of course, we made it through the beginning of January 2024, and of course, January 2025. We already have those policies being required to provide proof of flood. What I wanted to emphasize is, even with those 4 groups that I just marked out, that only represents 20%, 25% of our policies that will be required to have flood. So beginning January of 2026, for the next 2 years after that, 70% of our policies will be required to have flood insurance. And that's a significant, large number. And what I wanted to, when you look at the last bullet point, I wanted to let you know what this means to Manatee and Sarasota County. So based on the other slide, there's about 38,000 or so policies that these 2 counties have with Citizens. That means about 25,000, maybe a little bit more of those policies will be required to have proof of flood insurance beginning next year. So I just wanted to bring that to your attention, even though I know this is a commercial focused meeting. This is more of a homeowners, but I think it is something important for people to be aware of in terms of Citizens and our requirements. So with that being said, I'm going to turn the clicker over to Mark and let him talk about the agency side. Thank you.
Okay.
Max is driving.
Jump the gun there.
He's got you.
All right, let's see how we're doing here. Okay, again, thank you for the introduction, and thanks to Christine and Stephen. This is, I think, my 5th or 6th year in a row being on this panel, and it's always really informative for anybody who attends, and even myself serving on it and meeting in the months leading up to it. I learned different things about what to expect and how we can protect and serve our clients going forward. So thanks again for having me. My job, I want to bring my perspective as far as how all these different things in legislatively speaking or on the carrier side, how do they ultimately affect Main Street? Okay, over at Atlas, we've been here in Sarasota, 1 location, family owned and operated for about 73 years. Okay, so it's really important. We're not selling off to a big brokerage or a big national firm. We have to know what's going on to best serve our clients and be a good neighbor. That's not like a slogan that you hear on TV, but like you actually need to show your face in the community and be able to serve everybody. So I rely on their information heavily and their awesome resources. So from a Main Street perspective, you've heard the same spiel since I've been in the business going back 5, 6, 7 years. The market's getting tougher, fewer carrier options, worse terms, higher pricing. We sort of hit on that. And we were just getting some good news and things were starting to look more positive going forward. And it was a quiet hurricane season despite all the different prognosticators. And then what happened, last fall? We get Debbie, who decided to start raining and not stop. It wouldn't move. And you're seeing, places flood out east on Palmer. I think of like Laurel Meadows and different communities that are in X zones, and never in a billion years would they buy flood, much less even ask us about flood. Banks weren't requiring any kind of flood insurance on it, but Debbie turned out to be a nightmare of an event for us locally. And then you get Helene and Milton. And so here we are all year at places like this, touting all this awesome optimism and how great things are going to be going forward. And we've got great legislation, all true. The big caveat being what? Well, what if we have a nightmare of a hurricane season? It takes one catastrophic event. We sort of had 3. But there's a couple things that, despite those 3 events, we ended up in a really good position as a state. A lot of the reasons have been discussed, but number one, just backing up, insurance 101, basic stuff. Flood insurance is different than property insurance. And for anybody who's served on a board or been involved, you may know that and say, well, come on, that's easy. But a lot of people aren't fully aware of that. They're new to the state. Flood insurance is its own animal. So when you deal with an event like Debbie, that was flood. That was flood. So these property carriers, American Coastal, Citizens, whoever it may be, those property carriers were not the ones paying out the claim on those events. Anything that involved flood. Those are separate policies. That's FEMA, that's NFIP through the national program. There's a private flood market as well, but that had no impact on the property insurance market. Okay, so that's a good thing. It's bad news if you didn't have a flood policy, but for the state of our insurance market, terrific news. And then you've got the other 2 events, Milton and Helene. Well, most people here would probably know that there are 2 different types of deductibles in an insurance policy. There's a AOP, or all other perils. Simple way to think about that is fire, okay? Non-wind related events. That's usually much, much cheaper than a wind or named storm or hurricane, calendar year hurricane deductible. That's going to be a percentage. So you're going to see, for instance, I own $1 million building, or my client owns $1 million building. They have a $5,000 AOP deductible, and then they've got a 3% calendar year hurricane deductible. So in order, if you're going to pick and choose how to lose a building, not that we would do that, but you would want it to burn down because you're on the hook for that AOP deductible of $5,000. If you had a 3% hurricane deductible, you're on the hook for $30,000 because it's out of that TIV, that total insured value. Does that make sense? So I say all that. A lot of the damage that occurred locally from those events fell below someone's wind deductible. So again, it's 2 sides of a coin. Bad news is you've got $1 million building, 3% wind deductible. You incur $29,000 worth of damage. Is that really worth putting a claim in? You fell below your deductible. So that's bad news. The good news is the property carrier didn't pay out on that claim. Okay. So why is it good news? It's good news for the strength of our market because we had 5, 6, 7 years of bad news for our market. Prices going up, carriers fleeing the state. We needed some legislation, number one, but just positive news in general. How about a few years of less activity in the Gulf? Just to allow for some people to say, I'm going to reinsure carriers in the state of Florida, or, yeah, you know what? I'm this company, insurance company. I write property insurance in New England. I write it in the Northeast. I go out West. I'm just terrified of storms. I'm terrified of hurricanes. I want no part of Florida. If they start looking around and seeing these companies make some money, granted, nobody here is like jumping up and down for a CEO of an insurance company to make a ton of money, but we are all consumers here and we do need to buy insurance. I buy it. And you want it to be reasonable in price and you want it to pay out and available. In order for that, we need competition. We need carriers to be doing business in our state. Okay. We've hit on these issues pretty substantially, so I'm going to move this. All right. So again, my first 5 times here, I maybe started to hint at it last go around, but this is all the good news that we've experienced. So my first 5 years on the job, there was no stabilized pricing. It was maybe stable going one direction, up. Okay. So we're seeing prices stabilize and then soften. Capacity opening up. The more carriers we have, the more capacity. You know, they'll take on, you know, think about it this way. Say there was one insurance company insuring all the property in Sarasota County. And then say we had a horrific, you know, Hurricane Ian or worse storm. Think about Hurricane Ian down in Fort Myers happening here to that extent. Well, that one insurance company is done. You can spread it out between 20 different insurance companies. They're going to be okay to offer something, you know, that's cost effective throughout the state or around the country. Does that make sense? So again, capacity is increasing. They're all willing to take on more exposure. Favorable terms, that's keyword for deductible. You know, in a hard market, which we're coming out of a hard market, you saw 5%, 7.5%, and 10% on some properties. You know, in a softer market, you start seeing that trickle down to 3% and 2%, or at least being offered. Question, I know a couple of you know, hey, we've been at 5% the last couple of years. Do we ever get back down to 3 or even 2? It depends on the carrier. They all have their own underwriting guidelines. They all have their own comfort level with what they can offer. But at the peak of a hard market, you weren't getting 2% and 3%. A rare exception would be brand new construction, fire resistive, out east, away from the coast, preferable tenant. So, I mean, you would have to check like every box, whether it's commercial property, condo, whatever it may be. Then maybe you start seeing a 2% and 3% deductible offered. But we are seeing those terms just get better and better. And you hear about all the new carriers coming into the state. There's 2 types of carriers, admitted and non-admitted. So if you're admitted, you pay into the state guarantee fund. If you're non-admitted, you do not. You always want to be with admitted if you can be, because if they, for some reason, I know everyone's doing well on the insurance company side here now, but if they were to go under, go into receivership, or not be able to pay a claim, the state guarantee fund would step in and pay a claim. So all things being equal, we want admitted carriers. The reality of doing business in the state of Florida, you have to write with a ton of non-admitted carriers, especially on the property side. All right. And they get rated on their financial solvency, their ability to pay claims by different groups like Demotech, AM Best. There's a host of others that rate them. Okay. I'm going to hop down. I'm going to focus on, well, let's go through segmentation quickly. Not all properties are equal. Carriers are going to focus on specific areas. If you go by location, the coast being the most risky, out east or in the middle of state, the least risky. Age of construction, again, if you have we have a 19 late 70s home. Can't change the age of the home unless we knock it down and build it again. But you can update the building. We got a 2019 roof. There's different things that you can feature. So these carriers are going to segment based on location, age, their actuarial research and claims history as well in the past. I just came from a meeting today, and this will give me a good opportunity to back up. I want 3 people to stand up in the corner. Number 1, Haley, please stand up. So everybody give Haley a nice round of applause. Haley, tell us what you do and where you're from. She's fantastic and makes our life so much better. Can you tell she's from Wisconsin? Say Madison, Wisconsin again. Wisconsin. All right. Thank you. And then thank you, Haley. And then we have 2 more guys. I want to stand up and say who they are and where they're from. So there are interns this summer, and they're doing a great job as well. So any excuse to get them out of the office, we're going to take it. Anyway, the interns and I, we had a meeting 9:30 this morning with a president of a condo association. It's not coastal. New roofs, 24 units, 12 buildings, very straightforward, admitted carrier. It was not American Coastal, but it was admitted. Their rate went slightly down year over year. The premium went up about 11 grand. So let's see if we can put this together. Why would it have gone up on the property? The property insurance went up 11 grand.
So replacement cost.
Boom. Okay, so we got it. So it's replacement costs. They had to get a new appraisal a couple months ago. Here I am, and I warned them for about a year. And I'm like, just so you know, that appraisal looks light. It looks light. All right, we're on it. We're going to get so-and-so. Okay, good. So you send the budget letter out. Here's what to expect. Okay, we were within about 2 percentage points on that. Big asterisk at the bottom, depending on your next appraisal. Like, and that's not me doing it. It's not them doing it. That's nobody. That is the appraisal, and it's accurate. And it has to do with construction costs. It has to do with inflation, anything that's going to impact what does it cost to build something in our state. So again, that's one thing that's not helping insurance premiums at the current moment. Roof updates. Spoke to a roofing company this week, and this comes up a handful of times a year. The question is usually, how is an insurance company going to view this product? Either I sell it, I have it, I install it, something. I've got a product. It's probably really good. And somebody with a roofing company somebody can explain it way better than I ever could. And I'm not even saying they're wrong. I'm going to say they're usually right about why it's as good as a new roof replacement or close. The insurance company, generally speaking, wants everything start over, peel it off, put it back on a new roof. That's what drives the premium. Am I right or wrong?
Yeah, you got to have data on these products before insurers know that it works.
So, it's kind of a conversation where I appreciate the product. I get it. You're in better standing than you were without it. But if the question is, how does it affect my bottom line and insurance options? It's not usually considered a new roof. Okay. Now, one thing, so many people do have new roofs in this area because we've been through Irma 2017, Ian, and then this last storm season. We have more new roofs in this area than ever. And not to say there aren't more needed, but those new roofs work. Like, so if you're on the fence, put a new roof on because they stand up to the storm. If you're on the association side, there's like no wiggle room. You kind of have to, you have statutory requirements on the insurance. But if you're representing like a private investor and they own the building, if they have a loan on it, then certainly they have to, follow through the bank or the lender. But if they're at a point where they don't have to have a loan, they have some decisions to make. You can either insure with wind or X wind. And if you have a new roof, a lot of times you're doing okay with these storms. So just food for thought. Okay, reinsurance. So again, we've hit on these quite a bit. I mentioned Main Street. All right. This is kind of the fun part of my spiel. So this is a client of mine. Came in the fold. I talked to him maybe a year or two prior. Came on board last October. All right. But it was leading up to, it was probably a month or two out. So this person in particular represents somebody who has about 65 franchises, mostly one of your big three fast food chains. Wendy's is the name of it. Anyway, but
You heard of it.
Wendy's, and there's a couple others in that portfolio, but it's mostly Wendy's, and it's like from Manatee County down to Collier County. And so they have this huge property schedule, and I kind of knew what they had been paying in the past. The market had gotten tough. The markets were limited. You weren't going to deal with an admitted carrier. And so I'm kind of going about this, and the way you have to get the insurance for somebody like this would be through a broker. It's not going to be a direct relationship with an insurance company on the property side. So you have to, these different brokers, and there's several of them that we deal with. But, you see the total insured value. This is just a small portion of it. You see the type of construction, things of that nature. And what we were able to do, now go to that total, 973. Your eyes are probably going to pop out of your head. But the renewal was about $1.2 million that they had been offered. And so that number there was purely selling updates that they had made to their schedule, talking about their plans going forward, leveraging the relationship with a broker, playing around with deductibles, playing around with ancillary lines of coverage that maybe they had but didn't really need. There was flexibility, okay? And you see it broken out there between wind and ex-wind. Where's most of the premium?
Wind.
Wind, just a little bit, right?
Yeah.
So, you know, and that's through Lloyd's and then Gotham. So these are two non-admitted markets. But the point of me bringing that up, this is not for somebody in the association world, but if you have a private, you know, investor, if you have somebody who owns a business, there's usually some flexibility in what they have to insure, whether they want to go with wind or not. But you need to rely on whoever you're using for the insurance side of it. They have to have relationships with the E&S market, these property brokers, okay? Because that's purely, they're still spending almost $1 million on their property insurance, but it could have been about 1.2. If somebody clicked the automatic, like just renew button, that's a lot of money left on the table, okay? So, and again, part of that is made possible by the softening of the market. And that was last October 7th. So it was only starting to get a little bit softer, okay? So that's a big scale client. You know, that's a lot of different properties. That's, you know, in middle market world, that's pretty big. This is an example, and don't hurt your eyes trying to pick this up if it's a little small, but this is a commercial condo association. Tons of these around here, warehouses and whatnot, office complexes. So this one came into me from a friendly property manager in town, and they had servicing issues. They weren't sure, you know, if you go to your agent and you ask like, so, okay, this is what you're proposing, but where did you shop it? One of the most basic things everybody out here, you or your clients can ask for would be a marketing summary. A marketing summary is, it's a page in every one of our proposals, but you can send it different ways. All it's doing is it's the agent showing their homework. So if, you know, my wife's a kindergarten teacher, if it was a math problem, the kid, whether he gets the answer right or wrong, if you want to try to help him, going back 100 years, what do you say? Well, let me see your work, show your work, and I can see where there's a problem or what the deal is. In our world, you know, part of our job as an agent would be to shop and market. Well, a marketing summary shows your work. And what we had noticed, the previous group, they didn't really want to provide one. And then when they did, they missed. They didn't go here. Even if they didn't get the right answer, they should have shown that they went to that market 100% of the time. And they didn't do that. Well, so we were a little over $40,000 in the previous year. This would be a huge win because they ended up just over $23,000. So that's almost 50% savings year over year. Is that typical? That is not typical. That's a really good example that I would certainly use in a place like this. But what it is, the truth is, you got there because it took a little extra effort to shop it, to investigate it. You work well and had plenty of advance notice with the property manager and the owner. You have time to get a good result. If you don't do it that way, you don't really have time to get a good result. Okay. And that leads me towards the end here. So recommendations, one of the best things that we can talk about here today is how do you work, whether it's us or somebody else, how do you work with your insurance agent? Time is the best thing. So one of the best times to start talking and looking around, it's after a renewal. So say you just had a renewal and it was a average or way below average experience, bad experience. It's fresh on your mind or your client's mind. It's not a bad time to start talking around and figuring out, hey, who actually lives every day in that niche? Who would know the marketplace as it evolves? Who would have access to all the programs writing insurance for that type of opportunity? Because they're all different. Start that early. And if the agency's any good or the agent's any good, they're going to stay in touch and manage that the right way leading into the next renewal opportunity. But time would be far and away the best way to deal with an agent. The toughest thing I deal with, and I'm not telling you not to pick up the phone and call me, but it's like, hey, can you help me with this? Oh, sure. Great. I'd be happy to. When does it renew? Well, it's Wednesday at 5:05 p.m. It's Friday morning is the closing. Oh, okay. So I will try, but think about what we have to do to help. And I'm not asking you to be sympathetic, but just realistic. I have to get applications together. If I give it to an underwriter and it's incomplete and they got a stack of submissions this high and because everyone's shopping, they're going to look at this and say, there's Sobolewski from Atlas, again, not giving me anything to work with, or it's partial. They don't want to work on it. So if you want that last second miracle, I can't constantly put that in front of underwriters because they're not going to go to bat. Does that make sense? The time is the best thing. Building data. Oh man. So some of this you can see on permitting sites, and some people have receipts and inspections, and that's best case. But the more you can provide, the better. Like allow us to make a case and sell the property. Deductible options. That's part of our job to provide. Period. Win versus no win. Yeah, strong. So again, we're an independent agent. We have access to any program in the state of Florida on the property side. Okay. So that's what I have today. But with that, I'd open it up for questions.
All right, great job, guys. We appreciate it. We've got time. I think Max is going to pass around the microphones if you guys want.
Can you guys hear me? I got a quick question. Mark, Christine, and Steven. So when a major hurricane hits, what does that look like for you all after you make sure your family's safe and everything? I mean, are you guys working the phones? I'm sure it's a little bit different for each of you, but what does that look like after a Cat 4 or 5 hits?
Yeah. So really good question. The whole point of having insurance is to use it that day comes. But our situation starts anytime it looks like, hey, there's a storm to keep an eye on out in the Gulf. We're going to start having a conversation with every one of our clients. So personally, you'll get some kind of communication from me. Our agency will usually send out a couple messages as well. And there's a plan in place. So depending on the business, the location, specific needs, there's going to be a plan already in place. And then a couple numbers, a 24/7 number to call, protocol. Hey, here's how this works. One thing I didn't mention, we have an in-house claims advocate. So our agency has somebody to kind of hold, clients' hands through the whole claims process and make sure carriers are responding timely and in the right fashion. But really it's communication beforehand. And then we have, our office is off, Beneva, just in between Palm Ranch and Gulf Gate. And there's a generator and the whole deal. My wife, my dog and son, and I, along with probably 25 other people, stayed in our office this last go around out of an abundance of precaution. But we had a great time, never lost power, and had good news to come home to, luckily. So
I will say I don't know. This is my first hurricane season, not at Citizens in 20 years. And I won't steal Steven's thunder, but I will tell you, for companies, it's a year-round job. You don't just pick up and do well after a hurricane because you start when the storm hits. My team at Citizens was over communications, agent communications, agent outreach. And so we have phases of a CAP plan there that involves, we're ready to go before the storm even hits. Emails are going out. My old role would be also to reach out to all of the legislators. In what we have historically done there is start with whatever 62 counties the governor has been putting under the emergency order, because you just don't know where these darn things are going to go when they're, hedging our bets. So, and then you cull down from there when you know where the disaster zone is going to be, texting, making sure folks are safe, but know where to file their claim, what to do, how to get help. And then I have always, when I was at Citizens, deployed to the catastrophe resource centers where you actually go into the community. We were at State College of Florida, MJC, MCC, right? MTC, whatever you want to call it. State College of Florida and other areas. But I spent, for example, after Irma, I spent 3 weeks in the Keys. So you go out on the ground and there's nothing better than, I think, hand-to-hand service. But I'll let Steven talk. But I don't know, I'll let you know what this season's going to be like. Probably reaching out to our clients if we need to find out how we can help. If there are issues really with the OIR, we'll do a bunch of emergency orders about not, in the disaster zones, not being able to non-renew, not being able to non-renew for no payment, all kinds of exceptions that you can imagine are necessary so that people don't lose their coverage because they're not home, because they've been hit. Making sure that our clients are aware of and are complying with those emergency orders so that they don't get dinged on the back end and they know what's expected of them being pro-consumer, obviously the needs of the state and require to them so they don't get hit on the back end and they're doing the right thing. Or if they run into any hiccups on their own with claims response, that we're making sure regulators are aware of what's going on with our clients following an event.
Yeah, and the only thing I would add from an operational side is on the claims piece, we're here to fulfill our promise of the insurance contract. So at Citizens, and I would assume this is true for most carriers, we work with independent adjusters. So we only have so many claim adjusters in-house with Citizens. But if a Cat 4 is coming in the direction of Sarasota, Manatee, or wherever, we're going to need hundreds, if not thousands, of additional adjusters. So a big piece of the effort for Citizens is when we see that storm brewing and heading in our direction, we have an outreach to the independent adjusters that we have under contract saying, based on what we think the storm will do, we need X number of people in Florida to help us start working and settling these claims.
Ivan Gould. Two things about consumer education. The one thing that you pointed out about the deductible, the consumers generally do not understand that the 5% applies to the amount of the insured value, not the amount of the claim. So there's much more education required on that part.
That's right. And that was, I think it's less confusing every year because it probably gets explained more thoroughly every year. I know in our proposals, it is mentioned and then it's highlighted and then it's my job to say it and then say it again and then say it again. So you just have to say it enough to the point where it sinks in. It's not out of the claim. It is out of the TIV. But there's nothing worse than a client either being ill-informed or they don't remember, and there's a claim, and then you have to deliver that news. Hey, your deductible's $50,000, not $5,000, and that's not a conversation I've had to have, but it comes up.
And then the second point is consumers do not understand the difference between admitted and non-admitted carriers.
Right.
As soon as you run into a surplus lines carrier, it's a completely different ball game. I can't remember how many pages are in the FS, whatever it is. It's about 1,000 pages that applies to admitted carriers. And then the next section says, section, whatever the number is, does not apply to surplus lines insurers.
On the agency side, we prefer working with admitted all day long. The self-serving reason would be they pay more. The second, the better reason is the service is generally much better. Responsiveness, billing, anything. They're easier to work with on a claim.
Can I just add one pro-consumer thing? I think you are 100% right. As someone who did consumer outreach and education in my old role, deductibles are one of the most confusing things out there. They just always have been, always will be, unless you've had a loss and all of a sudden you're very well educated on it. The other thing that I think is critical, and I know, Mark, you probably do a phenomenal job of this, even if someone has damage below their deductible for a hurricane, file the claim. You cannot be dropped for an act of God loss, and it is a season-long hurricane deductible, calendar year deductible, meaning if you had some damage, your client had damage from Helene, okay, wind damage, but it was minor, turn it in, because when Milton hit, whatever they spent out of pocket on that loss from Helene, when Milton was the big one and you had a lot of damage, you only pay the deductible once. So if you had a 5% deductible and you had a 2% loss, and I'm using those two storms because I know they hit this area, in Helene, and you got walloped with Milton, you only owe that additional 3% against that Milton loss. It's critical. People are afraid to file claims that are below their deductible because they don't want to get dinged. And fire, other things, absolutely. When it's a hurricane, there is no downside to turning in a claim below. I did it. We had in Helene and Tallahassee. My husband's has a 440. He's getting his agency license back. He's been out of the business for a long time, going back. And he goes, "Why are you going to file this?" I looked at him and I go, "Have you lost your mind?" Like we had a 100-foot tree come out of our neighbor's yard, pull the power out of our house, and it was about, and some fencing. It was about $1,500 worth of. We have a 2% deductible on our house, right? That's a lot of money. And I was like, "Honey, if we get hit again," he goes, "Oh, right." I was like, put your, and he's like looking at me at 7:30 that morning, like I'm crazy. And I was like, it can't hurt us. And like, if we get hit again, it's early. Like we could get hit again. It is so critical that your clients turn in whatever it is, because if you get hit again, you don't want to have to pay it twice. And if you get hit a second time, then it gets messy about whether it was, you're going to say, I already had damage. Just turn in, if it's a hurricane loss and you have damage, turn it in. And Citizens does a phenomenal job, thanks to my former team and everybody and our claims adjusters. Turn it in, turn it in, turn it in. If it's hurricane related, it doesn't matter. Even if you don't think you're going to eclipse your deductible, just put it in and put it in timely.
Yeah, I'm here as a volunteer from a condominium association on Siesta Key. And they keep raising my pay, zero, they raise it 10% a year. But at any rate, I have a couple of questions. I guess number one is, I assume that all the insurance companies understand that the condominium associations should have contingency plans, and those contingency plans should encompass remediation as soon as possible. That said, when it comes time to settling the claims, our condominium association decided to hire an independent appraiser. And my past experiences, we felt that that's a good investment to make sure that we're getting the best results, and that the independent insurance adjuster may think of things that we wouldn't think of filing for. At any rate, we're down to the point of our association's total insured value is in the neighborhood of $50 million. And with a 5% deductible, you can imagine where we are. So we probably had $2.5 million worth of damages, and we're discussing the settlement. I'm not personally involved in the settlement, but Eric and I hope to get involved in it. But at any rate, my next question is, does Citizens have a review board? I mean, obviously, if we're not in perfect agreement on the difference between what Citizens is offering and between what our independent insurance adjuster is claiming, obviously one option is to go to litigation. Is there an in-house option for Citizens to mediate this claim?
We've got about 2 minutes left, just to let you know.
Okay, great. The best advice I could give on that is to, if this is a citizens related claim or citizens involved, reach out to the claim rep. I know you're working through a public adjuster, and that may cause some, conflicting conversations. Do we have a set remediation plan in place? We do have means to where we can work through these issues, with the policyholder. And I'm not trying to pass it off, but the best approach is maybe I can get with you after this conversation, get your name and see what we can do on our end.
Real quick on a 30,000-foot view, the quicker you can get a claim settled or resolved anyhow, the better. I say it because if you're going to own a property and be involved with one for a long time, next renewal is going to come around. And one thing that's going to hinder an agent is if you have an open claim, I can't get another property carrier involved. You just can't. They don't want a part of it. You want it to be resolved the right way, but once it's in your rear view mirror, we can kind of go forward. There's some nightmare situations of having open claims.
We've got about 1 minute left. Was there?
Really enjoyed this. Thank you. Just quick question on condos. I know initially it was 3 stories and up, and I was told like it's gonna by July 1st, 6 stories and up, by July 1st. Have you heard anything on that? And
913 does have some language in it about what is in the SERS and not. I cannot remember, and I don't want to give you wrong information. If you will let me get back to my computer, I will follow up with this group, and I'm sure that they will get it out to you. So yes, there is some language in 913 that alters that slightly. I just cannot recall off the top of my head what it looks like.
Yeah, that's.
So it's in there though. I will make a note I can look it up and get it to you guys. No problem.
All right, I think that's it, guys. They'll stick around for another minute, but I want to thank Stephen and Mark and Christine. Please give them a round of applause. And then just note that our next CREA meeting will be on the 3rd Tuesday of July, the 15th. It will be virtual, so you'll need to sign up for that. It's going to be on artificial intelligence in the commercial real estate space, but you have to register so you can get the link. All right, guys. Thank you very much. We'll see you soon.
You all involved, like you board member stuff or?
So I don't know if they want to do a quick picture, guys.
Sure.